Bank of America just dropped a price target for silver that sounds absolutely insane. $309 per ounce by the end of 2026. That's not a typo. We're talking about a 279% gain from today's price of $82. And here's the kicker. This isn't coming from some random YouTuber or fringe conspiracy theorist. This is Bank of America, one of the largest financial institutions in the world. Friday, February 13th, 2026, New York time. Please share in the comments what day and date you're watching this from. I genuinely appreciate seeing how far this message reaches. Before we begin, a quick note. I'm currently working to reduce copycat channels that mirror this content. If you find value in what I'm building here, the best way to support this effort is simply by subscribing and leaving the name George Williams in the comments. It may seem small, but it truly makes a meaningful difference. Now let's talk about what makes this prediction so extraordinary. Bank of America isn't exactly known for making wild, reckless forecasts. These are the people managing trillions of dollars in assets. Their research division employs some of the smartest commodity analysts on the planet. When they put out a target like $309 for silver, institutional investors pay attention. Hedge funds pay attention. Central banks pay attention. So the question we need to answer today is whether this is visionary forecasting based on solid analysis, or whether it's overly optimistic speculation that will leave investors disappointed. To understand how they arrived at this number, we need to dive deep into something called the gold-to-silver ratio. And I promise I'm going to explain this in a way that makes perfect sense, even if you've never heard of it before. The gold-to-silver ratio is simply how many ounces of silver it takes to buy 1 ounce of gold. Right now, with gold trading around $5,020 per ounce and silver at $82.90, the ratio sits at about 61.2 to 1. That means you need roughly 61 ounces of silver to equal the value of 1 ounce of gold. Here's where it gets interesting. Throughout history, this ratio hasn't stayed constant. It moves around dramatically depending on market conditions. During precious metals bull markets, something fascinating tends to happen. The ratio compresses. Silver starts outperforming gold, sometimes by a massive margin. We've seen the ratio drop to 40 to 1, 30 to 1, and in some historical periods, even 15 to 1. Think about what that means mathematically. If the ratio goes from 61 to 30 and gold stays where it is, silver has to roughly double just to maintain that new ratio. But if gold is also rising during a bull market, silver can absolutely explode to the upside. This is the foundation of Bank of America's analysis. They're not just pulling $309 out of thin air. They're looking at historical patterns of ratio compression during precious metals bull markets and applying those patterns to today's market. Let's do some simple math to illustrate. If gold rises to $6,000 per ounce, which isn't unreasonable given current monetary policy and inflation concerns, and the gold-to-silver ratio compresses to 20 to 1, which has happened before during strong bull markets, then silver would trade at $300 per ounce. That's basically how you get to their target. But we need to ask ourselves, is ratio compression actually likely to happen? Well, there are some compelling reasons to think it might. During periods of monetary uncertainty, when investors are fleeing to precious metals, silver tends to attract more speculative interest than gold. Gold is seen as the stable, conservative play. Silver is the leveraged bet on the same thesis. When precious metals bull markets really get going, the hot money flows into silver because the percentage gains can be so much larger. A 20% move in gold might coincide with a 50 or 70% move in silver. That dynamic is what drives ratio compression. And here's the thing. We're living in exactly the kind of environment where precious metals bull markets tend to thrive. The Federal Reserve is expected to cut interest rates by roughly 60 basis points by year-end. December retail sales have stalled. The GDP control group actually fell by 0.1%. These are signs of economic weakness that typically lead to monetary easing. When central banks cut rates and print money, hard assets like gold and silver become more attractive because fiat currency is being deliberately devalued. That's not a conspiracy theory. That's literally how monetary policy works. On top of the monetary policy backdrop, we have structural supply issues with silver that simply don't exist with gold. The silver market is heading into its 6th consecutive year of supply deficit. We're talking about 67 million ounces more demand than supply. For 6 straight years, the world has consumed more silver than miners have pulled out of the ground. Eventually, persistent deficits like this have to result in higher prices. It's basic economics. You can't run a deficit forever without either prices rising to incentivize more production or demand getting rationed through higher costs. The demand side of the equation is particularly compelling in today's economy. We're in the middle of an artificial intelligence revolution, and AI needs infrastructure. Specifically, it needs massive data centers packed with servers, networking equipment, and cooling systems. All of that uses silver. The electrical conductivity of silver is unmatched by any other metal. You can't just substitute copper or aluminum in high-performance applications. Electric vehicles are another huge source of demand. A typical electric vehicle uses 2 to 3 times more silver than a traditional combustion engine car. As the automotive industry transitions to electric, silver consumption in that sector is growing substantially. Investment demand is also strengthening despite the recent volatility. Global exchange-traded product holdings currently stand at about 1.31 billion ounces. Physical coin and bar purchases have been picking up in recent months. What's interesting is that even after silver crashed from over $100 down to the 80s, people are still accumulating physical metal. The smart money seems to be viewing these prices as an opportunity rather than a warning sign to stay away. Now, before we get too caught up in the excitement of $309 silver, we need to talk about why this prediction might not come true. And there are some legitimate reasons to be skeptical. Let's start with what happened just a few weeks ago in January. Silver broke through $100 per ounce for the first time in history, and then proceeded to lose nearly 50% of its value in a matter of days. U.S. Treasury Secretary Scott Bessent attributed this to Chinese traders and called it a speculative blow-off. If he's right, and that rally was primarily driven by speculation rather than fundamentals, then we might have already seen the high for 2026. The crash itself tells us something important about silver's volatility. This is not a market for the faint of heart. A 50% drawdown in days is absolutely brutal. Anyone who bought near the top is still sitting on devastating losses. The idea that silver is going to calmly march from $82 to $309 without multiple violent shakeouts along the way is probably naive. We could easily see another 20 or 30% decline before any sustained move higher. That kind of volatility makes it very difficult for investors to hold positions with conviction. There are also headwinds on the industrial demand side that can't be ignored. Industrial fabrication is actually forecast to decline by 2% in 2026 to around 650 million ounces. Part of this weakness is coming from the photovoltaic sector, which has been a major growth driver for silver demand in recent years. If solar panel manufacturers are using less silver or finding ways to be more efficient with the material, that's a meaningful headwind. The 2% decline might not sound like much, but in a market that's only consuming around 650 million ounces industrially, every percentage point matters. Let's also consider the sheer magnitude of a 279% gain. That would be one of the greatest commodity rallies in modern history. It's not impossible, but it requires almost everything to go right. You need gold to rally substantially. You need the gold-to-silver ratio to compress significantly. You need industrial demand to stay strong or accelerate. You need investment demand to surge. You need speculative momentum to build without another blow-off top. That's a lot of variables that all need to align perfect. It's worth comparing Bank of America's target to other analyst predictions to get a sense of the range of opinions. Alan Hibbard from Gold Silver is also bullish on silver for 2026, but his target is more in the $175 range. That's still incredibly optimistic, representing more than a doubling from current levels, but it's substantially less aggressive than $309. The fact that serious analysts are giving targets ranging from $175 to over $300 tells us there's legitimate disagreement about just how high silver can go. So what would actually need to happen for Bank of America's prediction to come true? First, gold would need to rally significantly, probably to at least $6,000 and potentially higher. Second, we'd need to see the gold-to-silver ratio compress from the current 61 to somewhere in the 20 to 30 range. Third, we'd need sustained investment demand with money flowing into silver ETPs, coins, and bars. Fourth, industrial demand would need to remain robust or accelerate beyond current forecasts. Fifth, we'd probably need some kind of catalyst, whether that's a geopolitical crisis, a currency crisis, or a major shift in monetary policy that drives investors toward hard assets. The timeline is also crucial here. Is 309 a year-end target for 2026, or is it a multi-year projection? If Bank of America is suggesting silver hits 309 by December, that requires an incredibly rapid rally. We're talking about going from 82 to 309 in less than 11 months. That's not impossible given silver's volatility, but it would require a parabolic move similar to what we saw in January, except sustained rather than a blow-off. If it's a longer-term target extending into 2027 or beyond, the probability increases substantially because there's more time for the fundamentals to play out. From a technical perspective, silver is currently testing a critical Fibonacci retracement level at $81.85. This is what traders call a make or break level. If silver holds above this support and starts building momentum, the path to retesting $100 opens up. From there, if we break through and hold, the next major resistance levels would be around 125, 150, and 200. Each of these would be significant psychological and technical barriers. Getting to 309 would require breaking through all of them convincingly. Let's talk about what this means from an investment standpoint, because a 279% gain sounds incredible until you start thinking about risk management. If you put $10,000 into silver at current prices and it goes to 309, you're looking at $37,900, nearly a $28,000 profit. If you put $100,000 in, that's $279,000 in gains. These are life-changing returns if they materialize. But here's the critical question. What's your plan if silver drops to $60 first? Or $50? Because with this kind of volatility, dramatic drawdowns are absolutely on the table. The difference between believing in a price target and properly positioning for it is crucial. Just because Bank of America thinks silver could hit 309 doesn't mean you should bet your entire portfolio on it. Position sizing matters enormously in volatile markets. Having 5 or 10% of your portfolio in silver with a 309 price target is very different from having 50% of your portfolio in it. The first is a calculated speculation with asymmetric upside. The second is gambling. Looking at the next few months, I think we're in a consolidation phase. Silver needs to digest the January volatility and build a base. If we can hold above $80 and slowly grind higher toward 90 and then 100, that would be healthy price action that sets up a more sustainable rally. If we break below 80 decisively, we might see a test of the 70s or even lower before the next leg up begins. The key is to watch how silver responds at these critical levels. For the rest of 2026, the catalysts to watch are Federal Reserve policy decisions, geopolitical developments, and industrial demand data. If the Fed actually delivers those 60 basis points of cuts, and the economy shows more weakness, that should be supportive for precious metals. If geopolitical tensions escalate anywhere in the world, safe haven demand could spike. If AI and data center growth continues accelerating, industrial demand could surprise to the upside. The honest assessment of probability is this. $309 silver is possible but far from guaranteed. If I had to put a number on it, I'd say there's maybe a 20 to 30% chance we actually see it this year. But here's what's important. Even if silver only gets halfway to that target and hits 150 or 175, that's still a near doubling of your money. Even a more modest move to 125 represents a 50% gain. You don't need the full 309 to make outstanding returns. The best case scenario is that everything aligns. Gold rallies hard, ratio compression accelerates, industrial and investment demand both surge, and we see a sustained precious metals bull market that takes silver well above 300. The base case is probably more moderate, with silver grinding higher through the year, retesting 100, and potentially reaching the 150 to 200 range. The worst case is another speculative blow-off followed by a crash, or a prolonged period of sideways choppy action that frustrates both bulls and bears. So is Bank of America's $309 target visionary or delusional? I think the truth is somewhere in between. It's based on sound analysis of historical ratio compression patterns and supported by legitimate fundamental factors. But it's also an optimistic scenario that requires a lot of things to go right. What I can tell you is this. Even if they're only half right, silver still offers compelling upside from current levels. The risk-reward at $82 looks a lot better than it did at 100. Drop your own price prediction in the comments. Where do you think silver ends 2026? And don't forget to leave George Williams down there to support the channel. Whether it's 309, 175, or somewhere in between, the silver story is far from over. Thanks for watching, and I'll see you in the next one.